Okay, good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. It is June the 30th. We have officially reached the end of this pretty volatile second quarter. Amar, good morning. Amar Najia, derivatives trader at BB Energy. Let me start with you. We've got a couple of headlines saying oil has fallen. Of course, it was softening throughout the week. Last week, we're back into sort of comfortable 60s. A few weeks ago, you were saying that your low baseline was going to be 58, and from there it would be upwards. So, do you think we're going to actually start to drift down to that 58, possibly again, now that everything's calm in the Middle East and everything's hunky dory? Where do you see prices going in the next month? Let's say now that we're kind of starting the third quarter.
No, I'm bullish now. I think basically that we're never going to see this, $55, blah blah blah,
Okay.
simply because I mean, if you look at oil in real terms, oil is the cheapest thing there is. It's cheaper than anything. Everything else has gone up. So if you look at like oil on an index of 100, oil is trading at about 82 plus or minus. Apple is trading at 102. The S&P index is trading at 115. Gold is trading 139 and Bitcoin is trading at 152. So you can't find anything that's cheaper than oil. That's one. Two, if you believe basically that Iran and Israel are basically all done and nothing's going to happen now, blah blah blah, then yeah, maybe you can make an argument for not buying. But I don't think that's true. I think basically the threat one to the other is existential. So you're either going to go see Iran collapse or you're going to see Israel collapse. So I think we're going to go considerably higher. I think basically over time, just on the technical picture, you're going to have to take out those highs at 135 on WTI, but obviously over a long period of time. But I think structurally, you've had basically the market move from the high at 135 during the war in Ukraine. You've had a corrective low from that 135 to $55 basis TI. And now we're starting on a new upward trend that's going to be with us for years, basically two, three, I don't know. And that is going to set a new all-time high above 135. So
Wow.
that's our narrative.
Okay, that's interesting. So we're all the way up from here, according to Amar. Paul Hicken, chief economist and editor-in-chief at Petroleum Economist. Great to see you. Paul, let's talk about that in the context of the supply on the market. I mean, we've got obviously OPEC plus who have been, playing the market well, not predicting necessarily, but luckily the market's gone their way. Let's say in the last few weeks, as they were increasing volumes onto it, and as there was a bit of panic over, possible. Disruption and everything was looking pretty balanced. There's a tight market at the moment fundamentally as well. But how does OPEC play this then in the second half of the year? Will that be a bit more of a predictable scenario? It doesn't sound like it from Amar. I mean, if Iran and Israel, the issue has not been resolved, again, more volatility possibly to come. What do you think they're going to be
Well, if you
playing in the
believe
next
Omar, you
months?
think OPEC should get all the barrels on straight away by
Which they're
the.
planning to. I mean, what are they going to do at their next meeting? You think they're
Well,
going
I
to
think well,
continue
there's
increasing?
yeah, I think that's the rumors out there already that the 411,000 barrels a day are going to come in August as well. I think it's pretty much that's expected. That's very much the base case, given that we've still got pretty strong summer demand season. We're back to talking
Yeah.
about those things, which is strong summer demand in the Middle East and the US. Um, I would say after that picture, after the summer, after we get into the sort of late Q3, Q4, I think then you start, I would say you get into a much more bearish picture. At the moment, yes, you look at a key barometer, say, the amount of stocks, the 5-year average, is quite low, and that's US stocks are still drawing down. So there is that kind of situation where we're in this sort of 60 to 70, maybe a little bit more than 70 range for now. But I think when you get into that later on in the year, then you start seeing the question about the wider macro picture. China's still, underperforming.
Yeah.
US, there's certain still those concerns around the US. We've still got the trade situation still unresolved. That time bomb's ticking away into sort of early July. So I think there's still a lot of factors, but at the same time, if you have that bearish trend kick in, then OPEC may change its plan. So I think for now you're sort of a 60 to 70, I think, holding pattern, but there's certainly bearish headwinds later on in the year.
Yeah, I mean, that's certainly what our survey, one of the questions last week said, most people said the second half average will be 60 to 70. Majority of people voting in that. And we've had, of course, a $70 average more or less in the first half. So weakening, according to some people, but perhaps not according to Amar. Alan, good morning. Alan Gelder, SVP of Refining Chemicals and Oil Markets at Wood Mackenzie. Alan, sort of the same question to you initially of the sentiment of where the market's headed, maybe from a products point of view, being your specialty, how does those markets should be looking at the third quarter as we go into the second half of the year, and compared to how they fared, let's say, in Q2?
It should be general softening because Q2 was strong because lots of refineries were basically out under maintenance. Our oil view is Q3 stays reasonably tight because this is peak summer demand. OPEC, having had its plus 411, hasn't actually delivered that over the recent months. We still think that's coming. So we think Q3 is broadly where we are, roughly where we are now, maybe a little bit stronger, but actually the problems all become a Q4 issue because that's when actually demand is weak. That's when you get reduced refinery runs. That's when a lot of non-OPEC supply growth outside tight oil comes on, and we'll have had significant volumes of the voluntary cuts being unwound, and so that's where actually we're quite bearish on Q4, both refining margins but also absolute crude price. There's lots of uncertainty with it, but yeah, that's our base case outlook.
Okay, thanks, Alan. So Amar, I mean, Q3 looks pretty strong. Perhaps it'll go the way you're saying it might, but I mean, Alan and Paul saying Q4 might be weaker. We've got the China demand thing that Paul also referred to. I mean, let's put aside that the Iran-Israel conflict remains calm, right? That we don't have any disruption or even Red Sea action in the next 6 months. Would you still be as bullish about oil just because of the fact that it's cheaper than everything else? Or could something throw a spanner in the works on that front?
No, there's a lot. Look, I mean, you have to kind of understand big, large patterns, right? So everybody can talk about what's going to happen in Q3 and this month, refinery margins, blah, blah, blah. I'm looking at a much bigger pattern. I'm looking back to 2020, 2021, all the way until now. The low is done. So people can believe it. People can have different opinions. That's what makes a market. They'll sell, I'll buy, and we see what happens. The bottom line is, if you look at oil, in terms of relative terms, very cheap. But even if you look at it on a basis, you've had a series.
What about the
of
trade?
lows.
What about the whole trade disruption negotiation impact on GDP macro? Is that going to impact sentiment at all?
Okay, look, I think basically what you need to kind of keep in mind is the world is massively inflationary. The BBB bill in the States is all about fossil fuels and nothing about wind. If you believe the dollar is tanking, the dollar is reached the floor, got a shovel out and started to dig. If you think that this market isn't inflationary, then there's something extremely wrong with the way you're looking at things. The S&P is rocketing higher. Why? Is it earnings? No. It's because there's nowhere else to put your money. What are they going to do? They're going to print. They came in at the beginning of this administration saying we're going to cut. Elon Musk gets pushed aside. There's no cutting. All they're going to do is print. The market is short. The market is short because you have a trend line coming down on oil. So it's a line that's going downwards, trending downwards, keeping the market in check. During the 12-day war, we tried to close above it. It was like 75.50 on WTI. We never managed. We went above it, closed below it, went above it, closed below it. When that close above it happens, everybody and his brother who is short, and they are massively short, is going to buy. No matter
so proportionally,
what.
how much is still short of the market? I mean, in terms of how much of that shortness has to still work its way out?
I think basically in terms of numbers, I don't know, but in terms of, the market is short. There's a trend line that's pushing prices lower, which means it gets easier to break every day. Stocks are outside 5 and 10-year averages, and you're coming up to winter and summer, and distillate picture looks extremely tight. And you have basically Lindsey Graham saying we're going to put secondary sanctions on Russia. over
Yeah.
the weekend that Trump agrees. I mean, you have to. I love the fact that people think that this market is going to go lower, et cetera, because we're just going to build a position the other side of it, both into the end of this year, into 2026.
Okay,
So,
thanks, Omar. Yeah.
yeah,
So
no,
long,
I'm
you're bullish.
yeah,
Bullish.
yeah, bullish everything.
Bullish everything. Paul, I mean, back to sort of OPEC as well, but let's talk a bit about their, and then again, they will adjust their policy as time goes on and add or perhaps pause some of what's planned in terms of releasing this 2 million, the remaining of the 2 million cuts that they've done, the voluntary cuts at least. But, internally, that now that, we're going to see possibly, according to you, possibly a softer market as the fourth quarter comes anyway, does that mean for internal dynamics on the whole quota compliance issue, which has obviously been managed well, but those things always will resurface, won't they, when there's a bit of pressure on the pricing front? Should we see a new pattern emerging, do you think, going forward on the sort of OPEC 8 agreement, etc.?
Yeah, I think it's a great point. I think, post summer, post this last August, which is likely to be this 411,000 barrels a day. Post that, I think it really starts to feed in the question then, wherever the market is, it really starts to feed into question what was the ultimate end goal of this OPEC strategy of releasing barrels. Now you can, for now, we can believe the argument, the surface level argument of OPEC, which is, the fundamentals make sense.
What about Iran and Russia's role within that now, given
Well,
geopolitics and given some dynamics around that?
Well, ultimately, yeah, exactly. And I think this is why it depends where the market's at, because if you believe it's to do with the fundamentals, if prices drop below $60 a barrel, that's not a price level that really suits anyone in OPEC plus. So you would think there was something else driving that strategy,
Yeah.
whether it's Trump pressure, whether it's there's the other arguments that have been played out. How much is it to do with internal compliance? They'll be looking back at compliance at $60 a barrel. Does that bring the non-compliers into line? So there's a lot of things which would then reveal how much it's beyond the sort of the market stability fundamentals argument, and how much the wider strategies of people talking about driving this OPEC policy.
Okay, thanks, Paul. And then let's talk a bit about China, because you've got the trade tariff negotiate, or they've agreed now, they've come to a deal with the US apparently. Maybe that's going to settle down a little bit. But just more sort of micro on the refining front internally in the country in terms of what oil it might be taking in for those refining needs inside and re-exports, obviously, of refined products into the region. What does that what are your sort of numbers telling you about the outlook for Asian demand, if you like? China's been stocking up quite a bit on inventories of crude. Or should we see more of that at this current price level before it goes up?
Well, we think, and if we're looking at Chinese inventories tracking sort of commercial, then they're back at the highest level since effectively a year ago, which is kind of this peak level aspect. So they've done the first half of the year build.
Yeah.
We think crude runs remain broadly stable. There is a challenge on the consumption tax they put on some of the teapots, which is kind of keeping runs down. And sort of demand growth is poor. The manufacturing PMIs are fairly low. So we're not seeing China as we're not expecting a huge sort of demand growth this year. It's relatively modest. Next year there is demand growth. That's more petrochemical feedstocks. Crude runs remaining stable. So we're seeing it relatively benign. I mean, one of the things that we're sort of starting to think through is we have China demand peaking relatively soon. So we think of the last 6 months, we've had effectively 1 million barrels a day roughly of inventory draw as commercial stocks have been built. If your crude runs aren't changing and arguably your transport demand has peaked, you don't necessarily need to build anymore, in which case that inventory build on the crude market might just ease away. Certainly, probably second half of the year. Does it rebuild next year? These are the things we're trying to get our head around. But some of these supportive factors we've seen for crude might start to ease. Asian refining margins, reasons. The big concern or risk we've got is reciprocal tariffs in under 10 in under 2 weeks' time, do they snap back? Because
Yeah.
there was something this morning that the UK is the only one that's got the nominal 10%. Everyone might revert, in which case that's a bit
Could
of a
impact
downside.
things.
That could
Yeah.
impact things. Yeah.
And and I mean, in terms of the refining intake, there was some press in the last couple of weeks focusing in on how much Iranian oil is China still taking. The teapots have
They can
started to come
take
under
as
more
much
pressure.
take as much as they want now.
But
can't
even
they?
the independents who are being
Yeah.
a bit more wary of the sanctions, although Trump admittedly was easing his talk last week. But I mean, has that really made any difference? That yes, no, back and forth on the Iranian sort of sanctions rhetoric from the US on terms of because there was some talk that there was some, they were slowing down on the Iranian intake a little bit because of that. Some of the
And we also had, when the tensions were rising, they moved volumes out from offshore Iran into Asia. So we've not seen such a dramatic change in intake. And the challenge for some of the independents is, again, the consumption tax policies have changed, which is kind of hitting runs. So we're expecting lots of uncertainties around what happens this week on the US-Iran negotiations. Is easier sanctions, less sanctions on Iran, some sort of means of appeasement or negotiating for what may happen on nuclear. So could Iran start to produce more? Possibly. Will the Chinese take more? Probably not, because they've been taking a fairly steady flow for a while. But again, that's another one of these things we just have to keep an eye on, because it's not clear which way that's going to go.
Omar, I mean, thanks, Alan. Omar, Iran is, the Iran front is one thing. What seems to be really escalating is the Russia-Ukraine crisis. We had supposedly the biggest bombing activity on Ukraine this weekend by Russia. No end in sight there, Omar. I mean, is that impacting sentiment in the market anymore? We're in the 4th year into this conflict. No end in sight. Is anyone paying attention?
Everybody's paying attention, right? Because you've got this, even the EU, I think it's like the 17th or 18th round of sanctions where they try and basically shoot themselves in the foot, the finger, the head, the temple, the back of the head, the mouth. They've tried pretty much every position. They should actually write a book. But anyway, so that's gone belly up. The next one, I think, is going to be this Graham sanctions, basically, and he seems to have Trump's ear with the war or skirmish in Iran. So I think that's coming, and when that comes, and they say basically to China, you can't buy this, and they say to India, you can't buy that. I think that's really going to drive prices. But the thing that people are kind of forgetting is that the US and NATO are losing in Ukraine. There's nothing that they can do militarily, absolutely nothing. It's just going to get incrementally worse. The only thing that's left is basically either a complete and utter surrender, which Trump will not do, or sanctions. And what sanctions? The EU ones are useless. So basically, the only ones are basically these sanctions on buying any oil molecules of any kind from Russia, or face sanctions. So I think that's going to happen. The other thing is everybody keeps talking about, ceasefire with Iran. So if you ask anybody, what's the ceasefire? What are the terms of the ceasefire for Iran? I don't know. Well, what's the object of the ceasefire? I don't know. What have they agreed? I don't know.
We don't know.
Well, either
they've agreed to disagree for now. Yeah.
No, they haven't agreed on sweet FA. There's no agreement on anything. That's basically, for me, that's a risk on the market. It's not basically, it's all okay and everything's
They've agreed to face save each side for the time being, perhaps. That's what they've agreed on.
And the sides
purposes.
Basically are 180 degrees. Trump is like, no. So I sent a video clip internally to Trump saying today, if they enrich any uranium at all, I'll consider hitting them again, right? And what are the Iranians saying? We're going to enrich uranium.
Yeah.
So you can. I mean, this.
Well, not just the Iranians. The IAEA is saying they can re-enrich the uranium anytime they want, even if we assume some of it's been removed. So this has never been a sort of reason. So as you said, what was the point of bombing? It was messaging, and who knows what's going to come. Thanks, Omar. There's our survey today, OPEC plus week again. They meet on the July the 6th. Have the oil markets already priced in another 400,000 barrels a day increase? Agree or disagree? They probably have, given the current conditions in the market that everybody here is expressing today. Paul, I mean, in terms of, oil supply on the market, what about, non-OPEC supply? We've got OPEC's declaring what it's doing, OPEC plus. That's pretty predictable, perhaps, and very, set out in front of us and transparent. But non-OPEC supply, how's it fared? US oil has sort of been stable this year. Is that more or less than was expected so far? What do you think we're going to end up with? And even other non-OPEC suppliers. We're not hearing a lot about Brazil and Guyana anymore.
Yeah, you're
Everyone's
right. You're right. Well, let's start with the US. I mean, yeah, I think a lot of analysts were expecting several 100,000 barrels a day increase from the US. So in terms of where expectations are versus reality, well, there were a few 100,000 barrels probably shy of that, and we like to stay shy of that because at these kind of price ranges, it does start to choke off. It does affect, especially shale. Maybe not so much the sort of deep water and the sort of big wider oil production, but certainly shale is affected by price, and it's a clear determinant. We start going down to lower 60s. We could start seeing even US production starting to fall towards the end of the year. So I think we're in a different dynamic now for US production from that, at least from the shale side. And then you've got Guyana and Brazil are still doing okay. I mean, but overall, you think about where people looking at supply and demand dynamics, and supply was gonna well overwhelm demand start at the early of the year. Even with weak demand, that's probably not going to be the case anymore, and that's where I probably buy into where Omar's saying, well, and why prices are staying in this kind of range for now. And to be honest, if you talk about the Russia-Ukraine situation, well, if you want to hurt Russia, lower oil prices is the way it's going to go. The market will determine that if we have enough barrels on there. So I think regardless of all these sort of ineffective sanctions, it's really price which will affect Russia as well. Price in the market is key. And going back to the question you said about OPEC plus, well, obviously we saw last time that how much is really OPEC, how much is Russia really on board with this when prices start to come down,
Yeah.
bringing on the extra barrels. At the moment, it hasn't really materialized because a lot of these have been paper barrels. A lot of the barrels are already in the market.
Yeah.
In the next couple of months, that won't be so much the case.
Okay, thanks. Thanks for that. Alan, I mean, let's talk a little bit about again, sort of back to the refining world, but in terms of sort of summer demand, gasoline, immediate sort of gasoline demand, driving season kicking in, jet fuels, travel season. I mean, I know you gave us an overview of what things are looking like for the third quarter, but have that sort of met expectations or not in terms of the July-August period that was coming up, especially Europe, travel demand into Europe, etc. How has that been impacted, if at all?
It's kind of yes and no, really. Yes, it's kind of met our expectations, but we've been lowering them as we've gone through the year. We started off thinking oil demand growth this year might be 1.3 million barrels a day, and now we're sort of quite comfortable in that it's probably going to be under a million. US gasoline demand has held up reasonably well, and reasonably strong, a bit stronger growth this year than last year. Jet demand is faring fairly well, but it's all pointing to a sort of a weaker global GDP outlook, a weaker broader demand growth than we've seen recently, and a lot of it is around uncertainty around the reciprocal tariffs, and US consumer confidence has actually been pretty low, and so people tend to be a bit reluctant on some of those.
And what about the
big spends.
US-Canada relationship, Alan? I know that's mostly about obviously the gas. There's always the gas reliance as well on that front, but US-Canada trade tariff talks impact on oil exports from both those countries and from the gas back and forth. Any talk of that in the market anymore, especially since Trump's headline last week that he's back on top of Canada's head again.
Well, but I think the US realized just if they if they put tariffs on Canadian energy, it just increases prices on US consumers, and so the thesis of the producer will bear the tariff, that will fall apart fairly quickly, and so that's just not somewhere that they're willing to go. So we just don't expect to see that happening. This coming back into the agenda. The trouble with all of the tariffs between is it just makes the economies of both nations a bit weaker, and we're just seeing all sorts of pain within the auto sector as a result of the incremental cost or the uncertainty as to what they are, and that just slows investment, that slows growth, and that isn't generally not a good thing for energy consumption, hence oil demand.
Thanks, Alan. Omar, you mentioned earlier that the US will have no choice but to cut, as in interest rates, and so we're going to have more liquidity, and therefore that feeds into inflation, etc. Trump was talking a bit about replacing Powell, or maybe he'd like to, whatever. Well, I mean, the Fed story has sort of quietened down a bit, maybe because of uncertainty of what's going to happen. But when do you think we're going to see further interest rate action, do you think, in the US? Would you say that we're going to see that in the next quarter? And how much? How much?
Like 100%. Like, is the sun going to come up, and are they going to cut interest rate? The answer is 100% yes, and it's not because
But the economy is still okay, right? So where's the justification?
The justification is that they have $9 trillion of debt that they have to refinance. So basically, what you're going to see is they're going to try and cut interest rates, basically, to try and bring those 10-year yields down, right? But if I'm correct, I think these 10-year yields are going to start moving from the current 4.4 to above 5, like now. Like, this week, next week, they're going to start moving in that direction, right? Which is going to make it very expensive for them to refinance. So what you have is, it's not the Fed that needs to cut rates. It's basically Treasury. Why is it Treasury? Because they need to borrow. They cannot afford to. They borrowed that 9 trillion at an average about 3.3%, right? Now you're talking 4.4%, maybe 5 point something percent. It's unaffordable. They're paying over $1 trillion to finance this. People are quite, don't really understand. Why are we seeing the dollar nosedive? Because people see this. Why are we seeing the passing of the Genius Act? Because they have to find a way to get anybody to buy US treasuries. Why don't countries want to buy treasuries? Well, because they seized Russian assets. They seized basically all their money. There's no trust anymore. So they're kind of trying with the Genius Act. They're going to try with stable coins. They're going to try with all this kind of stuff. They're going to cut interest rates no matter what. Even if inflation is at 10% and all the rest of it, they're going to cut interest rates. Why is everybody buying the S&P? Because they're going to cut interest rates, which means there's going to be a flood of money. Inflation is going to go up. The dollar is going to continue to debase. Why? Because their debt is 37 trillion. The BBB bill adds another 3.3 trillion of debt.
So debt will reign over inflation, and they'll inflate their way out of it. I guess that's going to be the case. Omar, thank you. Paul, let's go back to you as we start to wrap up. I mean, we mentioned sanctions, we've mentioned Russian oil, Iranian oil. In terms of shipping, and that's not necessarily your specialty, but again, obviously that's been a big focus in the last few weeks, especially as the Iranian issue ratcheted up. Flows in terms of back to Suez or not, the choices there being made, obviously freight rates quite dynamic in the last month or so. Do you think that the market will be a bit calmer now or not?
Well, yeah, I think there is a certain
and the impact on dark fleet.
Well, there is a return to normalcy. I mean, the dark fleet is, I mean, we saw. I mean, things carried on as they did. So I don't think there's going to be a huge. I think it's not going to be a huge impact there. I mean, the real question is whether we start seeing any other low-level disruption in the region. Not so a complete break of the ceasefire, but the sort of low-level, sort of, rogue situations going on, and that's likely to sort of undermine sentiment in the market. I think that's where the risk really is.
Okay, but in terms of monitoring, for example, I mean, that's in the Middle East, but what about Russian flows? Is anyone even paying attention to that anymore? I mean, intake by India, for example, of Russian oil, have we seen a change in that at all? Have they been a bit more sensitive to that?
I think if you talk about the impact on the overall market, I don't think the market it looks at balances, and the market has shown its adaptability to adjusting to flows. And India buying all that Russian oil was a response to adaptability in the market anyway. So and I think what's happened over the recent last month or so is that it's shown that the sort of risk premium, the risk on the Strait of Hormuz closing was shown as was a very minimal risk,
Yeah.
despite everything else going on, and that's what's shown where oil prices didn't even go up to the prices which were seen at the start of the year. So I think it's shown the market adaptability and shown where the lower levels of risk really in this market and the sort of extra capacity we have to and the flexibility to cope with that.
Yeah, I mean, that certainly was the test for the Hormuz risk premium. And clearly, nobody believes that's the step that the Iranians would take, even under the circumstances that we saw the last 2 weeks. Thanks so much to Paul Hicken, Alan Gelder, and Amar Najia for joining us this morning. Happy end of second quarter. Let's hope we see more, a bit more stability as we enter the second half of the year on all fronts. Perhaps not for traders, but on the political front at least. Thanks so much. That result from our viewers today, obviously 100%, that won't remain that way when we put it out there to everyone else. But yeah, that's probably not a surprising result as well. All the best, everyone.
Thank you. It was
Thanks,
interesting
guys.
to know
Enjoy
Mark's
the rest of your
comments
day.
today. Thank you very much, everyone.
Bye-bye.
Thank you, guys.